I'm Nigel D'Souza, and shortly with me will be Lata Venkatesh. We have 60 minutes to close the trade, and who would have thought? We started off on the back foot, but as we speak, the Nifty is up and going. Just take a look at that. The Nifty, a big recovery. Intraday low today was at around 10,535 odd. So from those lows, we have recovered nearly around 190 to around 200 points. Massive recovery on the Nifty Bank as well from the lows of the day. The Nifty Bank is up nearly around 500 points odd. We have seen a sharp correction the last few days, but today, in fact, the bulls will feel quite good that at least they managed to defend the 10,500 mark, 10,535 odd mark. Hi, Lata. Good afternoon.
Hi, good afternoon. Yeah, actually, you put the number correctly. 10,535 was where we've turned, which was about the 20-day moving average. And the 50-day moving average also was a bit of a help.
Yes.
So it does look like from that point we have turned, but it's still too soon to call a victory. It's been an extremely volatile market. As well, it's been based on, very thin trades.
Right.
A lot of institutions are not out there. At the moment, we seem to be tracking the S&P futures or the Dow futures to some extent, and those numbers will come up for you. In the morning when we opened at 10 a.m., the Dow futures were down 100 points, and that explained why we also opened, we opened lower and went even further lower.
Right.
By 11 a.m., actually, the gap had gone to minus 200 points. But I've just taken 2 or 3 time points. At 12 noon, the gap was reduced, and then we started recovering at that point. And at 2 p.m., we saw that gap, Dow Jones futures going into the green, and we practically followed suit. So to some extent, we are clinging on to this hope that the global sell-off is probably over and we could get some kind of a help. We must also remember that in all this sell-off, we have a little bit of positivity coming from the crude prices, and expectedly today, the yields are lower, but we've not got that much help for the rupee. The rupee strengthened to 69.70, but now it is back at 70.08 or 70.10, which is about 4-5 pice below below the Monday close.
Yeah.
So, we're not strengthened much in spite of a $7 gain in crude.
Yes.
So clearly at some point in time, we are going down with the world, with the global risk off.
That's right, Lata. You put it perfectly in terms of tracking the Dow futures. That's something that really has been giving you the swing in terms of trade today. Very, very importantly, at the low point of today, we had corrected 430 points in just 4 trading sessions. So you had every reason to believe that there is going to be some short covering at some point of time. Let's get straight to the levels then today that were defended. 10,535, and the second level that Lata was talking about is the 50 DMA. So both those two levels, as of now, they have been defended, and the bulls will believe that tomorrow's expiry, they can at least defend that mark. Now, that's around 140 points away from the 50 DMA. Very important, Lata, the call writing we were talking about in the morning. From the top, the call writers, they have packed their bags, because in the morning itself, in the first hour of trade, the 10,600 call had added more than 20-25 lakh shares. Currently, there's only 6 lakh shares added.
Okay.
So that's telling you that nearly around 15 lakh shares from the top have unwound those positions. Similar is the case as well with the 10,700 call. And finally, the 10,500 put, the most important mark, given that tomorrow's expiry, the bulls will say that, looking at the addition out there, 15 lakh shares have been added. They'll believe that maybe, in fact, they can defend that mark. Resistance levels, as you said, 200 DMA, 20 DMA. Both those two levels should come up for you. So maybe 50 points at most on the upside, and the bears will come back to fight. Okay.
We'll have to wait and see, of course. If the bulls are able to hold out, then the bears may even have to cover, and they may provide that kind of a cushion tomorrow when it is expiry day. But we have to see where the initiative swings. Let's tell you what's lined up on the show, and we'll discuss much of this. The main headlines at this point in time, 1 hour to market close. Market shrugs off weak global cues, shows a sharp, significant recovery. Mid-caps do recover, but underperform frontline indices. What are the key headwinds for the market as we approach the next year? We discuss that with our experts, SP Tulsian of sptulsian.com and market expert Ambarish Baliga. Also, in these volatile times, how are mutual fund houses relooking at their India strategy? What are the key changes in their investment portfolio? We discuss that with Tahir Badshah of Invesco Mutual Fund. And finally, 2019 will be the year of general elections. What does that mean for the market? And what could be the top sectors to look at? We will be asking Dhananjay Sinha of Emkay Global Financial Services. But before we get to all those thematic discussions, let's begin with our technical experts to take us through what is left of the trading day, the crucial last hour. We will be asking Ashwani Gujral and Mitesh Thakkar how they position themselves in the last hour of trade. Good afternoon, Ashwani and Mitesh. Thank you for joining us. Ashwani, the market is playing treacherous both with the bulls and the bears, finding support at the 10,540 mark. What do you do? Last hour is good to go long at all?
Well, first of all, I'm glad that in 20 years we have made CNBC anchors fairly proficient technical analysts. So, when you can't explain it, go back to technical. Anyway, I think the last hour will be the best of what we've seen during the day in terms of upside. And given that, for the first time, Dow futures in many days are now trading in the green, I might just even carry these long positions on Bank Nifty, because when that first big up day happens, it won't be 50 points on the Dow. It'll be more like 450, 500. So my sense is bears can sense it, and they are not going home with any short positions, that's for sure. Whenever the market will bounce back, the same stories, low bond yield, interest rate, this, that will come back. So it will just not work while the markets are going down. So now you'll see by the end of the day, Bank Nifty could easily gain another 100 points. Now, what does this mean on an overall scenario? It means we'll go down less with global markets. We'll go up much more when things turn around. So today, an interesting sector has come back, which is capital goods, cement, those sort of capex heavy stocks. So today I have a few interesting stocks. One of them is GTND. That's a buy with a stop of 274, target of 288. Siemens is a buy with a stop of 1025, target of 1070. Larsen is a buy with a stop of 1400, target of 1510. Now the advantage of these stocks is nobody owns them, nobody looks at them, nobody has them. So it's very difficult to take these stocks lower. And the way they are moving, I think the next leg of this bull market is probably coming on stream. And from here, those infra and capex type stocks could do much better.
All right, Ashwani, in the morning you had told us to close the short positions, at around that 10,530. So that trade worked perfectly well. Now you're saying maybe you look to carry these long positions. If you're carrying that long position, what are the levels you're looking at on the Nifty, given that tomorrow we have an expiry? And also, if someone's making money, where do they place their stop loss on the long trade?
Well, since it's been a sharp rally, your long trade stop can be, say, closer to 10,680, 700. So we've kind of regained a level that we had broken. And, you have to be nimble in these markets, because they will not let you off if you get in at the wrong time. Similarly, Bank Nifty, I think 26,800 thereabouts. But I think there is more to come in this rally, because it looks like, the world is going to bounce from here.
Okay. That's fairly positive, even if it is only for the near term. Good afternoon, Mitesh. What are you doing with your index trades? What do you have already on board? And what for the last hour?
Yeah, good afternoon, Lata. We've been trading short for the last few days, which got triggered out today on the trailing stop basis around 10,585 mark. Since then, I think nothing much on the index, but it does look like some kind of a reversal, which at least in the short term will suggest that we might not fall much. I think the Bank Nifty, if it continues its strength, starts getting past 26,950, we might attempt a long. For the time being, I think I agree with Ashwani. Capital goods look like a very important sector. I think stocks like Siemens, L&T, BHEL all look good to me on the charts, and I would be comfortable taking a long. The ones which I've identified right now are MGL is a buy with a stop at 874 for targets of 900, and Siemens, I just mentioned that. That's a buy as well. Keep a stop at 1,009. Look for targets of 1,065.
Well, as is typical of these times, when the indexes, when the contracts are about to expire, you find HDFC very active. Today, actually, that's singly contributing to many indices where it figures. HDFC is up 2%, and HDFC Bank as well is up about, almost 2%, 1.6. Ashwini, any trade on these?
See, definitely in the morning when all other banks were lower, HDFC Bank was kind of bouncing back. I would think it could easily have another good day tomorrow, and chances are, even if you buy right now, you could get upside by tomorrow's expiry, because those levels will be dramatically different from the lows that we saw today. So that way, I think the market momentum is on the upside. If it gets a nice gap up, then I think there will be more short covering even here.
Okay, all right. Thanks so much, Ashwani, as well as Mitesh. We'll come to you all in the next half hour or so in case of any revision of strategies. For the time being, the Nifty is up 200 points from the low point of the day and holding on to those gains. So let's get in Mr. Tulsian of sptulsian.com, as well as independent market expert Ambrish Baleka is with us in the studio as well. Good afternoon, gentlemen. Thanks so much for joining us. Well, Mr. Tulsian, I want to come to you first. These oil sensitives or crude sensitives, they're doing very, very well. All of them are gaining, the likes of Apollo Tires, you have a Berger Paints that's moving higher. Even the aviation companies are moving higher. What's the view on some of these stocks? And is there any particular sector you'll be looking at playing, given that crude oil prices have corrected so sharply?
See, Nigel, in the morning I've said that one has to look for the crude sensitive stocks and other than the OMCs. And actually in the morning I've said for the tire stocks, paint stocks, and maybe the airlines. And one or two sectors, still comes to our mind is about the cement stocks, because if you really take the call, they are going to be seen the beneficiary because of the reduction in the freight rate and reduction of the petcoke prices. And apart from that, maybe paint stocks is included in general, but again the crude derivatives, maybe take the case of like Pidilite Industries, or maybe the benzene based stocks which are seen to be like Aarti Industries, or maybe say Shea Industries kind of stocks where the prices of raw material has fallen. In case of Pidilite, if I just want to add here, the prices of VAM, that is vinyl acetate monomer, have fallen by about $150, or maybe to 15-16% in this maybe last couple of weeks. And as against that, they have in fact gone for the price hike also when the crude was moving up. So these are the stocks where one should really keep an eye on, apart from the OMCs, because I don't think that OMC theme can really work on from here, because they will be seen, they need to pass on the benefits of the reduction in the Brent prices. Apart from that, they will be having some kind of inventory loss. So other than OMCs, we have been taking this theme of taking a call on the tire, paint, cement kind of stocks, which has played out, and that's what I've said in the morning as well.
Okay. Fair point, sir. Didn't notice this. Pidilite and Aarti Industries also beneficiaries of crude intermediaries, those raw material prices going down. Actually, there is a steaming rally out there in the Nifty Bank, up about almost 1%, 0.9 actually. I mean, it's all the private sector banks that are leading, so it's not the usual PCA beneficiaries, prompt corrective action types. It's in the forefront are HDFC twins, HDFC Bank, then Axis Bank and ICICI Bank. Those are the top four gainers. There is also Bandhan Bank, which is doing well in the finance space, but we will come to that in a bit. And Kotak Mahindra Bank. Okay, so that's the five big constituents of the Nifty Bank doing exceptionally well at this point in time. So this is not dependent on any government policy. Yeah. It's quite clearly someone betting on growth. Ambrish Baleka is also with us. Ambrish, good afternoon. Thank you very much for joining us.
Thank you.
Well, what's your take on these private banks? I mean, Kotak is kind of dangling because of regulatory issues, a court case,
right,
possible M&A, we don't know. How do you approach this stock?
See, M&A would be positive, but the regulatory issues which are there, clearly, I think that was an opportunity to buy Kotak Bank at lower levels. I mean, we had seen that correction in between because of the regulatory issues, because of the case they had put on RBI. I think that was an opportunity to buy Kotak at lower levels, because any long-term money, serious long-term money, which has to get into banks, will clearly get into these 4 or 5 private sector banks. But like earlier also I've been saying that if you're looking at the next 9 to 12 months, I'm more positive on the PSU banks, because there the bounce back could be much more than what possibly we could see for the private sector banks if you're talking of the next 9 to 12 months, because already we are seeing that the recovery should be crossing about 1 lakh crores, and I think that that number will keep adding up. So I don't think the market has yet discounted that, I mean, so much of recovery can happen and the NPAs could flatten out. I think that should play out in 2019.
Okay. Well, personally, because we pursue these cases, I'm just worried about the IBC process itself. The whole thing is under discussion by the at the Supreme Court, and hearing after hearing is just passing by. We're not getting any word, but it's just a little scary that yes, there is a big recovery. SR Steel recovery is 45,000 crore, but where is the money? Quarter after quarter, we are postponing that check. So at some point in time, the market will perhaps begin to wonder whether it's factoring in too much. One wants to see the check finally. Actually, that same question to you, Mr. Tulsian, but more from the Bandhan Bank end. That again is in the regulatory crosshairs, possible M&A, various ways in which to meet the regulator's norms. How do you approach this stock?
See, Lata, in regard to prospective acquisition of the group finance by Bandhan Bank, I've expressed my view a couple of days back also that it should not happen that just to meet the regulatory guidelines, the Bandhan Bank lands up in buying some expensive assets. Because if you really take a call now on the group finance, if you take their PAT margin, it is about 20% of the income. I'm just taking the loose analysis, which can justify that the acquisition of the GRA will be very expensive. And if you really take a call on the price to book or maybe P multiple, the Bandhan Bank is ruling at a P multiple of 30 to 33, while Guru Finance is ruling at a P multiple of 48 to 50. So if Bandhan Bank is trying to acquire Guru Finance such an expensive valuation when all other housing finance companies, though we have been keeping extremely positive view on the housing finance company going forward, but if instead of acquiring PNB Housing Finance and if they are going for the Guru Finance with such a stiff valuations, that will be seen hugely EPS decretive. That may serve that may achieve the purpose of the meeting the part requirement of the RBI to dilute the promoter stake to 40%. But I don't think that this will be a wise move on part of Bandhan Bank to acquire such an expensive company in the home finance space when so many other stocks or maybe the companies are ruling at such a low valuations.
Afternoon, Nigel. I would go with a buy in a M&M Finance, stop loss of 471, target of 495, and a buy in a Siemens, stop loss 1026, target 1065.
Okay. Any disclosures? You have positions, Sandeep?
Well, I don't hold any positions in the stocks that I have discussed. Our clients may be holding positions in some of the stocks.
Okay. Well, thanks for that. Mr. Tulsian, this constantly referred theme of capital goods and infrastructure coming back into fashion. Infrastructure one can understand, and we can discuss that a little later. But, capital goods we can discuss later. But infrastructure, GMR Infra or HCC, all these are highly beaten up stocks. Would you really look for any buys in the infra space?
See, Lata, I don't think that we will be looking any of these infra stocks where the assets are held by the company and they are struggling to monetize the assets and reduce the debt. You have mentioned about GMR Infra, again having a debt of closer to about 20,000 crore, GVK at closer to debt of about 10,000 crore. Similar is the case with HCC. Yes, one can look for the pure EPC players, maybe like NCC India or maybe like J Kumar. These are the stocks where really looks quite good, because take the case of the Mumbai city alone, the projects of about 1 lakh crore, 100,000 crore, maybe if you take the Navi Mumbai airport, coastal road, metro roads, and all these projects have been backed by these 3-4 companies. One can include the name of L&T also for infra as well as capital goods both. So maybe, but I don't think that we will really be keen to acquire the assets where the infra company where the asset monetization things are involved.
All right, Mr. Tulsian. Well, even though the market is moving higher, a couple of stocks are moving to the low point of the day. Sun Pharma has moved lower, for example. That's down close to 2.5% when the markets are seeing, a big recovery. Amrish, I wanted your view on the pharma space. Stocks like Sun Pharma, they used to be one of the blue chip stocks. Now, various question marks being raised. How are you positioned on pharma and Sun Pharma in particular?
No, in fact, on Sun Pharma, I was bullish earlier, no doubt. But then with the sort of performance which it has shown, especially in the last 2 quarters, that's been disappointing. And to top it up with the corporate governance issues which have come, I think one should stay away for the
Avoid
time
it.
being. Absolutely. Right.
Okay. Mr. Zulsan, what about the capital goods space now? Siemens, yeah, all of them, L&T, Cummins, GE, T&D, any of them?
See, Lata, in fact, this space is really seen to be doing quite well because of the consistent order inflow and because of this acquisition of the NCLT assets.
Yeah.
Whether you take the case of the steel stocks or maybe the cement stocks, the things are again having revived, because all these existing projects which have been acquired by the new promoters needs huge kind of capex and upgradation. If you really see the statements, all the steel companies acquired are talking of expansion. So that is seen quite positive for the capital goods sector, and in fact L&T definitely features on top of the list because of the infra and capital goods presence both. But in the capital goods, I think we should be focusing more on the companies like maybe Siemens, ABB, GE Power and CG Power, because if you really take a call on all these four, either they have the scope of P expansion or they are seen to be ruling at a very low valuations. So we will be selective in taking a call on the capital goods space. Probably we may remain away from the companies like BHEL and all sort of things at this stage, but seen buyer in ABB, Siemens, GE Power and CG Power.
Okay, so I'm going to spring a question to you, which may be a bit sudden, but it just occurred to me that in the morning, one of the newspapers was speaking about a cap on royalty for up to 4% of sales and maybe 7% of profits, if I'm not mistaken. But if such caps were to come, are there any stocks that will be, that will be positively impacted because under law they have to pay lower royalty? Would it be some MNC companies that we should think of?
See, Lata, that may seem, benefiting many companies. To start with, Maruti could be one of the case, HUL could be the another stocks, but I don't know how far that will really be seen coming in and what kind of representations, will be made by the foreign promoters. But if it comes in, there are many companies, like as I've said that maybe these two companies, Maruti, HUL, but practically in all the MNC companies, this payment of royalty is involved. It has only to be ascertained that what kind of quantum is being paid by them. Even you can include the case of the cement stocks also in case of ACC and Ambuja Cement both, because again there the foreign promoter is being paid royalty. So I think this will be seen overall positive. One has to compile the whole list and take the call accordingly.
Yeah, we were trying to do some, but I'm just wondering whether ahead of a general election, a government will go into something as major as this. But maybe leave it for the time when they come back to power or a new government comes back to power. Mr. Tulsan, thank you very much. Is there anything you want to disclose?
No, nothing, but similar advice is given to all our clients, and we are holding investments in whichever stocks we have discussed, maybe like Maruti kind of stocks.
Okay, fair enough, sir. Ambarish, I just wanted to ask you, the market appeared to give a dip and go towards 10,500. It turned. Are you a buyer now, or do you think that there are going to be better levels very soon, probably in a quarter?
I've been a buyer since the last 1 month. Okay. And when it was down closer to this 10,300 levels and from there it had bounced back, I said, this is clearly a time to buy. And any sort of a correction which we see even going ahead, I don't think it'll be a one-way move. We'll surely see some corrections, but all those corrections are to be bought into. Because if you look back about a month and a half, 2 months back, the major issue which we are facing was the rupee and oil. It was not really the global markets or the FII money flow, because FIIs have been pulling out the money for the last, the whole of 2018. So with the rupee and oil in place, I don't think that's an issue anymore. And our domestic funds are still flowing. Although a bit less, I don't think we should be too worried about the FII flows. If they come in, I think that's a bonus. So looking at, from that point of view, I really don't see the markets really going down further from here. I think we should see a decent uptick till the elections. And if you look at the last, say, 5-6 elections, we've always seen a pre-election rally. And especially now, after the assembly elections, I think it's quite clear that the general election would be more bipolar than a hodgepodge government going ahead. So I think it'll be a stable government. It's quite difficult to say which one, but it should be a stable government with a decently strong opposition. I think that is most important for a stable government to be, to be in place. And I think that is exactly what the market likes.
Okay, so you are buying in anticipation of a pre-election rally as well?
Absolutely, yeah.
Okay. Thank you very much, Ambarish and Mr. Tulsian, for joining us with your thoughts today. Markets clearly in a fine fettle at this point in time after the early morning blues. Practically all indexes are in the green, and the advanced declines also 3 in the green for 2 in the red. With that backdrop, let's invite Tahir Badshah, the CIO of Equities at Invesco Mutual Fund, to check out what the fund management community is making of the year ahead. Good afternoon, Tahir. Thank you very much for joining us. Well, I don't have to recount, but just to briefly place the backdrop, the positives, as Ambarish was just telling us, is that crude and rupee and bond yields, the liquidity in the money market are all the positives that are working, and perhaps a nascent capex cycle also, given the capital goods second quarter numbers. But on the other hand is a very treacherous global backdrop. Which way would you tilt, bull or bear?
I think I'm reasonably aligned to what Ambarish's view was a few minutes ago, and I think the important thing for us, at least from an India standpoint, is to realize that as an outcome of whatever is going on in the global scene, I think the developing factors are positive for us. We have obviously oil and the rupee coming back in control, and that's a very big positive for us. They were the same reasons essentially for which the Indian markets were actually in trouble the prior 6 months or 9 months. So one has to appreciate the fact that those have turned for us. So quite a lot of the macro is clearly getting better. I think from a global standpoint, at least our global view from an Invesco standpoint is that the US markets and the US economy will continue to grow reasonably well and with low inflation for some more time to come. And clearly we are not in the camp where we are tilting towards the possibility of a recession assuming coming about in the US anytime soon. Also, of course, the US markets are kind of adjusting to the fact that earnings growth out there will probably be a little lesser than what it has been in 2018. And to that extent, the current market correction is probably in line or is consistent with that development. But the only thing which is probably surprising markets or spooking investors is the ferocity of the fall. And I think the ferocity of the fall has a lot to do with the nature of the markets out there, which is significantly moving towards ETFs and passives and so on. So we are seeing these kind of 5%, 4%, 3%, 5% moves in a day. But by and large, I think they were primed for a little bit of correction. And I think it is quite natural for that to have happened out there as well. But doesn't mean that India should follow. I don't really think so. We should probably decouple. We have been decoupling for the last 2-3 months. We are headed into elections, but I think that being the only hindrance. But otherwise, I think quite a lot of macro factors of ease for us. We could probably look forward to a liquidity-driven rally as well in the markets over the next 3 or 4 months' time.
Well, Tahir, if all the macros, the worst of the macros are the worst in terms of crude oil prices, the rupee is strengthening as well, macros are improving, then what would your allocation be? The Nifty is flattish in the last 1 year. The mid-cap and small-cap indices are down 15 to 25%. Time to allocate some money out there?
Absolutely. I mean, I think this is what we've been proposing and advocating for quite some time now. We have been staying shy of the mid and small cap space for almost throughout the last 12 to 18 months time, except where by mandate we are necessitated to do so. But otherwise, we had a larger tilt towards the large cap space. But now, increasingly over the last 4 or 5 months, we think that a zone has arrived where the mid and small caps have actually started to look a lot more attractive. Valuations have become a lot more reasonable. Some have even become cheap, if not and not just reasonable, but they've become cheap as well. So to that extent, we feel that mid and small caps, we're clearly getting a lot more constructive. So much so that we actually had the courage to even go and launch a small cap fund 2-3 months ago. So I think clearly that's a space which we are a lot more positive about. We believe that there are bottom-up opportunities scattered across different kinds of industries. in this space, and we are willing to take advantage of that.
Okay, that's a brave man out there to have put a small cap fund, but it's a golden touch, looks like. The small cap index has done well in the past, say, 12, 16 weeks or so. But Tahir, just a word more on the macro growth environment, earnings environment, before I, start drilling it down to specifics. See, the growth picture and the earnings picture is also marred by what we saw in the auto space, for instance. And it was not just a year-end phenomenon, because we were looking at YOY numbers. So, seasonally adjusted, we've not got much to write about for the Hero Motors, for the Marutis of the world, or for the two-wheelers of the world. I mean, Bajaj Auto put behind a 30% growth year-to-date in volumes. And yet today there was a note of caution in what Rajiv Bajaj told us. The problems in terms of increased prices of motorbikes simply because of safety standards, BS6. This whole growth picture is not looking all that good if you looked at these consumption indices like auto consumption.
Yes, so the consumer discretionary space and the consumption space has clearly slowed down over the last 4-5 months. Different reasons for different sectors and segments of the market. Two-wheelers, it's a different story. Four-wheelers, it's a different story. Maybe we've seen other parts of, let's say, building-related construction and consumer discretionary related products to construction have actually been also seeing a softening trend. So every sector has had a different reason. But generally, there has been pressure simply because, we've seen a little bit of scare on interest rates. We've seen also liquidity-related situations. We've seen the NBFCs pulling back as well. So there has been a certain amount of impact, but some of these are also reversing. So, for example, oil, and that should be beneficial to autos, I would guess. A larger part of it is also because of reasonable pressure on the rural markets too, and rural incomes as well, as a result of food price inflation being where it is. So I think, yes, we've gone through that cyclical element of consumption slowdown. But I think stocks too have reacted negatively for that. Valuations have come off, so they've probably become a little more interesting now than what they were some time ago. So I think the story still remains. We still have so many of these segments which can show reasonably decent growth, if not humongous growth. But I think they are now relatively better priced and better valued than what they were. So I think they're providing some good entry points as well, in my view.
Tahir, what about this contra fund that you're running? Is it a value fund or a growth fund? There's a mix of financials in there. I think, I don't know whether it's a contra bet you've taken. There's BPCL that finds a mention out there, Tech Mahindra as well. Give us some clarity on this fund.
So contra essentially is obviously a growth. It's a value-oriented strategy. It is not a growth-oriented strategy. But and wherein we are, really very particular about buying stocks which are inexpensive and cheap on valuation. So that happens to be the starting point of that fund. We also look at some part of the portfolio which is related to growth at very, very reasonable prices or GARP kind of stories. But by and large, it is about companies which are undergoing stress. They have probably been going through a certain amount of headwinds in their respective industry, or maybe for certain particular reasons of the company. And they are available at valuations which are considerably cheap, or maybe cheap relative to their own historic valuations. And where we believe that they have a reasonably decent franchise, such that over the next 2-3 years, if the business cycle turns right for them, they would be in a position to get the maximum benefit out of that improvement as well. So we try to buy into those kind of franchises which are available at reasonable valuations or are cheap, and right through the cycle over the next 3 to 4 years time, and try to make returns thereof.
Okay, so
that's essentially what we do in the contra fund.
Okay, so would your buys be more investment led rather than consumption led? To go back to my original question.
Yes, you could say that probably we will have a slightly higher tilt towards investment compared to consumption, but we are willing to, even in that fund, buy consumption-related stories which are available at reasonable valuations, or which are cheap, where franchises have actually turned cheap. So it would therefore also spawn sectors like financials or some consumer discretionary, or maybe even things like pharmaceuticals and so on. So which you wouldn't say, are very deep cyclical. So we would have a good amount of representation of that part of the market as well.
In the rah days of NBFC, we started creating more and more subcategories as reasons to buy. We created mutual funds, we created insurance, we created wealth managers, and all these stocks were running up. Now what is left of finance as a good buy for 2019? Only corporate banks?
Well, from a perspective of cheap valuations and a good possibility of earnings recovery, the corporate banks obviously stack up pretty well. So that's one part of it. Some of the NBFCs in the recent rout have also turned cheap, especially those which have a slightly diversified basket of products and not monoline. And even some of the platforms, like for example, there are many companies which are just share platforms which don't really carry as much of balance sheet risk, and they are probably linked to the capital markets or the equity markets and have turned cheap in the recent past, are also kind of looking as reasonable candidates for the next leg of growth. So I think there are a good number of pockets of the BFSI space as well, which have turned value or have turned contra or probably are growth at reasonable price opportunities.
All right. The rupee, as you said, macros are improving, so the rupee has gained some strength. You have various IT stocks that are part of various funds. At what stage would you start getting cautious on that sector? Are you positive on it, firstly?
Yeah, we are reasonably positive on the sector still, and we are essentially going by the fact that they still have a fairly decent amount of growth ahead of them. Of course, it's not blistering growth, but I think at the valuations that they trade, which is more like still at a discount to the overall markets or to the benchmark indices, and for about a 12-13% kind of growth, they are reasonably valued. So I think that's why we like them. We believe that even though the rupee probably could go against them in the near term, but business momentum appears to be getting stronger. And most of the IT companies, as we know, post the last quarterly result, have indicated at improving pipelines in terms of deal intensity, etc. So I think the business conditions are looking relatively stronger compared to what they were about a couple of years ago, even as valuations are still reasonable or cheap. And that makes us believe that probably that is what is probably going to be appreciated more by the market than just the negativity on account of the currency that we have been seeing in the recent few weeks.
I'm told we are completely out of time, but a very quick question. Is the debt market problem over? So do you look at HFCs and stuff like that? Or, do we need to wait?
I wouldn't say that the problem is over, but I'm not a great judge of this segment, but I would like to believe that at least we are past the crisis. So the problem is still there. The crisis maybe is over, and debt market conditions are looking to normalize. It's getting reflected in, as you know, in the improvement in the 10 years as well, and that's something which is providing some confidence. Liquidity transmission and rate transmission is still relatively slow, so to expect that rates will come off very significantly and cost of funds will go down meaningfully is still not entirely clear. So we are approaching this NBFC space with a little bit of caution. Like as I said, we would probably prefer NBFCs which are a little more diversified in their product basket than being completely monoline. So that's how we would probably want to look at it.
I got that. That's why I asked you, whether HFCs in particular are buyable at this point in time.
Yes,
got it.
not
Got
as
it.
much.
Okay,
Yes.
Got your point. Thank you very much, Tahir, for staying with us and clarifying on so many issues. Have a great 2019 yourself and everyone at Invesco and, of course, in your family.